The biggest banks in the United States are disclosing their financial performance for the third quarter this week, and it's becoming increasingly obvious that the situation might be far more dire than our initial predictions. The big shot banks in the US, Wells Fargo, Bank of America, and JP Morgan Chase, are announcing approximately $5.3 billion in combined third-quarter charge-offs on their overdue loans. A charge-off is essentially the amount owed to you that will never be repaid in full. The estimated $5.3 billion in charge-offs is a conservative approximation, and we are nearly sure that the actual sum is significantly larger. The most troubling aspect of this situation is that not only these major banks, but also numerous smaller banks are experiencing charge-offs on a substantial number of their B-rated loans. These losses have been lingering on their financial records for some time, but only now are they choosing to acknowledge them. The reason for recognizing these losses in the third quarter is to avoid the appearance of abruptly writing off billions of dollars in uncollectible loans within a short span of a year, which would undoubtedly reflect poorly on them. Shareholders would be greatly disappointed. To mitigate the impact, they are absorbing a significant blow at the moment and are expected to charge off a smaller portion by year-end. They aim to minimize the fear among investors and the public, and this is the unfortunate truth. The cumulative charge-offs in the third quarter have reached their highest point since mid-2020, when the pandemic was at its peak. The $5.3 billion charge-off is also nearly double the figure reported by banks for the same period last year. This means that we are merely witnessing the initial stages of what's to come, given the escalating delinquency rates. Bloomberg claims, and we concur, that these charge-offs will continue to escalate, forcing banks to officially document significant losses rather than carrying them forward month after month as they currently do with unrealized losses on commercial real estate loan portfolios. This impending development could potentially deliver a fatal blow to numerous small and medium-sized banks, resulting in their likely closure next year. In essence, as flexible work arrangements and remote work persist as the norm, vacancy rates are skyrocketing. This surge in vacancy rates for office buildings is causing landlords to experience significant cash flow losses, which will inevitably affect property valuations and contribute to a decline in the value of commercial real estate loans. The situation sets off a domino effect that extends far and wide. Banks are tightly regulated entities. Regulators mandate that banks maintain a certain level of liquid cash as reserves, anticipating the potential charge-offs in the future, typically within 6 to 12 months. In such situations, regulators might insist that banks augment their reserves. Consequently, banks will need to keep a large sum of money readily accessible, set aside for the expected volume of non-performing loans in the upcoming period. As a result, not only will acquiring loans become increasingly difficult due to higher interest rates, but lending standards will also become more restrictive. We share the same sentiment regarding credit unions. Additionally, if banks have more cash reserved, it marks a limitation on their investment capacity, leading to a probable decline in their earnings. Recent reports indicate a decline in trust in the banking system compared to previous levels. According to recently published data from Bank of America, consumer funds are experiencing the most significant outflows since February 2014. Here, you can see that the outflows during the first 2 weeks of October were nearly twice the levels observed in any other 2-week period throughout the entire pandemic, excluding February 2014, which saw the largest 2-week inflow on record. In summary, brace yourself for witnessing more banks facing difficulties. According to the Federal Deposit Insurance Corporation, the second quarter unrealized losses totaled approximately $558 billion, marking an 8% increase from the first quarter. This trend not only persists during the third and fourth quarters, but worsens as well. That's about it for today's video. If you liked our content, do subscribe to the channel for more. Thank you so much for watching, and we'll see you on the next one.